Hi, this is PR Sundar. Welcome to this special episode where I'm going to tell you something very interesting. So, in the sea, there are some small fishes, there are some medium-sized fishes, there are some big fishes. What happens? The medium-sized fishes eat the small fishes and the big-sized fishes eat the medium-sized fishes. So, that is the life in sea. Now, same thing is happening in the stock market. So, this story is all about explanation of that story. Number one, here small fishes are the people who are option buyers. So, people with some small capital, so they expect the market to fall, they go and buy a put option, market go up, they expect, they buy some call option. And the medium sized fishes are the option writers. So, they sell the options to these small fishes, they eat their money. And this is what has been going on for a long time. And that is why 95% of the people, they don't make money in stock market. About 89% of the people, they lose money in stock market. And most of the people who lose are the people who are option buyers. Option sellers, once in a while they lose, because, many times option buyers will lose, but sometimes they win. But many times option sellers, they win, but sometimes they lose when the markets move very violently. But overall, it is the option buyers who lose the money because they are small fishes, option sellers who are the medium sized fishes, they eat them. Now, for the last few months, the things are changing totally. The last few months, the markets are making very sudden move. I think one Monday, about 1 or 2 weeks before, on one Monday, the mid-cap Nifty fell 2% in a matter of 1 minute. And those who traded in mid-cap Nifty options, they lost heavily. I think just 2 days before, Nifty fell 200 points within 1 minute. And I was just watching the trading terminal, although I don't trade, but I used to watch. 2 rupee option has gone to 120 rupees, all in a matter of 1 minute. A 15 rupees option gone to 300 rupees in a matter of 1 minute. And at the same time, 15 rupees call went to 20 rupees. So, what these people call, they call it as injection, a sudden spike. And, many option writers, they have been demoralized for the last few months. And some people even left their profession, left the trading totally, because, the loss was unbearable. I heard that on last Thursday, this Nifty injection, I think many even pro accounts, proprietary trading accounts also, they have lost even 30%, 40%, 50%. And people put stop loss, but the stop loss jumps, right? So, why all these things happening only for the last few months? Why it was not happening all throughout the year, right? So, there was no answer. But suddenly, today, I saw some news. There is one hedge fund in US called Jane Street. And there is another hedge fund called Millennium Hedge Fund. So, this Millennium Hedge Fund, if I am not wrong, that is the 5th largest hedge fund in the world. And Jane Street may be a smaller hedge fund. So, what happened? So, Jane Street has filed a case in a US court against Millennium Hedge Fund and 2 of the employees of the Millennium Hedge Fund. So, what this Jane Street people are saying, those 2 people were actually employees of Jane Street and they left the company, and the Jane Street has spent millions of dollars to develop some algo to trade in Indian stock market, and using that strategy, they have made 1 billion US dollars in 2023. That means in 1 year, they made about 8,000 crore profit. So that's almost every day 30 crore. That's a very, very huge amount of money. And what these Jain people telling the court, so we developed a strategy by spending millions of dollars and we were making $1 billion last year. And now in the last 1 month, the profit has come down by 50%. And they were saying that these two employees who are working in Jane Street, they left the company, they joined Millennium Hedge Fund, and there these two people tell the same strategy there. Now Millennium Hedge Fund is executing this strategy. So because of that, our profitability has gone down by 50%. So please give punishment to those two employees and the Millennium Hedge Fund. So this is the case in US court. Now, actually the Jane Street lawyers, they mentioned this, by mistake. So by mistake, they told which country is that. The country is Indian stock market. So just imagine what can be a strategy where you can make 1 billion US dollar in 1 year, that too, using a computer. No, you are not taking the market view, right? Okay, it's the computer doing everything. So probably, I'm not saying this has happened, but probably what could have happened. So that is my, my rational thinking, my logical thinking. So what these people do, these people are watching, okay, medium-sized fishes eat the small fishes. How? By selling options, right? So by selling options, I will tell you two dominantly played option. One, people with 1 crore, 2 crore, 5 crore, 10 crore, that they do intraday short straddle. They sell call option and put option at the same strike price. At the money, they put a stop loss on both the sides. Market goes sideways, they make some profit. Market trend in one direction, no problem. One side stop loss hit, the other side they get the profit. Okay, and the problem will come only when the market chop around, falls, then shoots up like that. So this is one set of people. Another set of people, people who have a large capital, they used to sell, far out of the money option for 2 rupees, 1 rupee, So far out of the money call they sell for 2 rupees, far out of the money put they sell 2 rupees, they collect 4 rupees, 4 rupees into 50 is become 200 rupees. The capital required for this about 1 lakh rupees. For 1 lakh rupees, if you are getting 200 rupees, for 1 day, if you do this for 4 trading sessions, that means every Thursday in Nifty. So you get about 800 rupees. So that translates into about 0.8% return per month. That translates into about 10% per annum. So these people are getting 6-7% in FD plus again 9-10% in trading. So they get about 16-17% return. They are very happy because if somebody having 100 crore capital, even 16-17% will translate into 16-17 crore. So this is what people do, right? Now, in fact, I'll tell you a real story. That was the time, my broker has introduced basket order. So I was trying some basket order. That's the number one. Number two, those days, the brokers were allowed to give leverage. If I have 1 crore, the broker will give 10 crore limit for me to do the trading. So what I used to do those days, if I have 1 crore, the broker give 10 crore. So let me give a simple example. If I have 1 lakh, broker give 10 lakh. So what I do, I sell option for 2 rupees on the downside and 2 rupees on the upside. I get 4 rupees. 4 into 50 is 200 rupees. Okay, that's for 1 lot. But if I have 1 lakh rupees, broker give 10 lakh rupees as the limit. So 10 times 200 rupees is 2000 rupees. But my capital is only 1 lakh. So for 1 lakh, if I am getting 2000, that's a 2% return. That's per week. And then if I trade for 4 times in a month, I get, 8% return. Once in a while, you have a stop loss hit, so even you lose 3-4%, you still gain 3-4%. So this is a very, very famous trading strategy we used to do those days. What happened one day, my broker has given 10 times the limit, right? I was supposed to place an order. I was supposed to sell. That day market was bullish. Market was trading actually higher. And I wanted to sell far out of the money put option for 2 rupees. So when I was doing the basket order, okay, I don't know what happened. So when I choose the options, okay, later, automatically they change to futures. So I was supposed to sell far out of the money put option 15,000 quantity. I think if I'm not wrong, that time the bank nifty lot size may be around 50. Okay, this has happened many years before. I don't remember exactly. So let us say the lot size is 50. The 15,000 quantity is almost 300 lots. Right? 300 lots is not a very big one. It's or maybe let us say 500 lots. Maybe 500, 600 lots is not a big one. Market is open in green and bank nifty is trading at a higher level. That's why I wanted to sell far out of the money put option. 15,000 quantity, I made an error trade. Instead of selling far out of the money put option, by mistake, it was a future. 15,000 quantity future. I click at the market order. So suddenly this 500, 600 lots market order it went. Okay, believe me, the bank nifty crashed by 150 points. 150 point now may not be big because now it is trading around 45,000, 48,000. But those days, I think it was trading around 10,000 or 15,000. 10,000, 15,000, falling 150 rupees is almost 1%. Right? So immediately I realized the mistake. I squared it off. I booked the loss. But why I'm telling you, just 500, 600 lots, you go and put the market price, even in a bullish market, the bank nifty comes down by about 1%. So now my point here is that, okay, option buyers are small fishes, option sellers are medium fishes, they are eating the small fishes, and now these big fishes are watching the medium fishes. And what these people are doing, on one side there's a huge number of players, they are doing a short straddle with a stop loss. Another side, huge number of people selling 2 rupee put option and 2 rupee call options. And they, using a computer algorithm, they calculate, what is the total average, the number of lots they are being traded, how much is in the open position, and then, if you go and put one order, market order, very big quantity, and how much, market can crash within how many seconds, all these they are calculating. And then what they are doing, say for example, one day let us say the market is very, very bullish. When the market is very, very bullish, what the people do, far out of the money put option, people will sell for 2 rupees. Right? The intraday short straddle people, okay, so their call may be slightly in trouble, but put with they'll be sitting in a good profit. So what these big fishes will do, slowly they go and buy put options, and then slowly they go and sell call options, and in huge quantities. So anybody do, it will be reflecting in the open interest. So you will see more and more put buyers. Okay, but these medium fishes, they will not think that the big fishes are doing this. They will think the small fishes are buying the option, it's good. Then slowly there is an addition of selling of call options. What these medium fishes will think, no, there's a huge open interest addition in call option, people are selling. Right? So that means another medium fish is doing that. That's what they will think. So they will never know that the big fish is doing. So what this big fish do, after executing all the trades, after buying a huge amount of put options, after selling huge amount of call options, what they will do, I'm just giving an example. Let us say it's a Wednesday, is a bank nifty expiry. Right? HDFC Bank, Kotak Bank, ICICI Bank, State Bank. if these 4 banks put together, it has about 80% weightage in Bank Nifty. So what these people may do, let us say they put 100 crore each. 100 crore HDFC Bank, 100 crore ICICI Bank, 100 crore Kotak Bank, 100 crore State Bank. They put a sell order at the market price for 400 crore at one point of time. What will happen? Definitely Bank Nifty will crash 500, 600 points. So what happens? So the put option they bought will give huge profit. Call option they sold will also give huge profit. Then these are like computer design. Once they put the market order, sell order, and then 500 point they will place a buy order also. So the fastness it comes, so the Bank Nifty will be bought at 500 point lower. After that, even if market recovers, so the profit in the future will compensate the thing. So somehow, they will make profit in put option buy also, call option sell also, and, future cash market short also. So number one, for a long time, we had only Nifty expiry, only once in a week. Okay. Then Bank Nifty expiry was also on Thursday only. So either you can do Nifty or Bank Nifty, but we had only one expiry per week. Then what happened now, because exchange want to make more money, they introduced everyday option expiry. Monday mid-cap Nifty expiry, Tuesday Fin Nifty expiry, Wednesday Bank Nifty expiry, Thursday Nifty expiry, and Friday, Sensex option. So what happened, the medium fishes, they are so much eager to eat more small fishes. So instead of doing in other instruments, so everybody started trading daily expiry. Monday they do mid-cap Nifty straddle, Tuesday they do Fin Nifty straddle, and every day. So because every day this is happening, so the big fishes, they get more chance. And now another problem is that, assume that big fishes do this every day. No, every day if they do, then you will know that everyday market moves like this. At some point of time, this medium fishes will get out of the market. So that's why these big fishes don't do this every time. So they do once in a while. So they take a huge amount of money. But now what has happened, probably this Jane Street was doing this. I'm not saying that they have done, okay, but probably they could have done this. So now 2 of their employees have gone into Millennium. Now Millennium is also doing the same thing. So this Jane Street is going to the court. Now you see, instead of 1 hedge fund, 2 hedge funds are doing this, right? And then, more and more people come and do. So then, it becomes more and more frequent. So in fact, almost every 1 week, at least once in a week, this kind of injections are happening in our stock market. Nifty move 200 point, Bank Nifty move 500 point, mid-cap Nifty move 2%, and all this happening in 1 minute. Okay, see, a sensible person who want to sell huge amount of shares will never put a single order at 1 second. Because that when you put a single order in 1 second, market likely to crash, okay, you are not going to get a good price. If a genuine investor, if he want to sell 500 crore, right, so he may sell 10 crore now, 10 minutes later he will sell another 10 crore, 10 minutes and later he will sell another crore, so that, without disturbing the market, okay, he will be able to sell huge amount of shares, at a price, market price, without crashing the, because if price crashes, like your share also, you are not going to sell at the same price. Prices will fall, you will have to sell at a lower price. So genuine investors will never sell huge amount of shares at one go. But what is happening for the last few months, huge selling happening in 1 second and 2 seconds. I remember in the last 1 month, okay, 2 incidences where mid-cap Nifty fell 2% within few minutes, and then last Thursday, Nifty fell 200 points within 1 minute. So this is happening. This is clearly, operator's game. So people say trading is a zero-sum game, But actually, that's not a zero-sum game, if you consider the brokerage, STT, stamp duty, everything into consideration. But on top of which, if one US-based hedge fund can make $1 billion, then if there are 10, 15 hedge funds come into our market, and if they're making 10, 15 billion dollars, so what is it you and me going to get? So seriously, I advise you, I would say boycott the intraday trading, right? So we have to force the exchanges to stop this nonsense of everyday expiry. So if the traders stop trading, they don't do the intraday trading. So these hedge funds also cannot play with you, right? And then, when there is no popularity, in US, the VIX is also trading. VIX futures, VIX options are also trading in US. Like that in India also they introduced, because there was no volume, they stopped. So if more and more traders boycott, if nobody is trading intraday, then, exchange they will have to get out of all these things. Only once in a week, only Nifty expiry, even Bank Nifty, even let them have all expiries also. Let them have Nifty, Bank Nifty, Mid Cap Nifty, but let it be everything on one day. Why every day expiry? Right? So, but I don't think that, my video is going to have such a big impact so that the traders are all going to stop. But let me warn you, the traders, either you stop now or you will be thrown out of the market. Okay. And I already heard, people losing, huge amount of money in the last few months. And there are some smart people who have actually left the market already. So my simple advice, okay, if you are my simple advice to them, so far all my advices were for small fishes. So this is my first advice to the big fishes or medium sized fishes, stop trading intraday. Okay. Especially on mid cap, fin Nifty and other things. Okay. So the more you trade, okay, exchanges will get more business, and these other countries, hedge funds will take away all your money. Okay. Then, you will be in a big trouble. So I'm not saying that this has happened, but there is a possibility of this happening is very, very high. Otherwise, you just give me a good reason why market should fall. Okay, if you think that, assume that you have a 500 crore worth of shares. Do you think you will put the entire 500 crore order in one go? No, you will not do it. No sensible person will do. Right? And in fact, maybe, regulators must come out with questioning the people who are putting 500 crore order in 1 second. Right? So, no, nothing is going to happen. Right? So at the end of the day, as I came out with a video last time, you have to save yourself. You cannot expect the government or regulators to come and save you, right? So my simple advice, don't do intraday trade. And for the big people also, don't do this 1 rupee, 2 rupee option. That's more dangerous. So that is advice. You want to take it, you take it, because now I'm officially a senior citizen, 60 plus. I think I have, liberty to advise the people. Otherwise, when I was young, I always used to tell, don't ask for any advice. So hope you enjoyed watching this video. Thank you for watching.